let's take a look at some of the news here. Let me know if anyone caught this yesterday. I was joking around with the happy hour people. On happy hour, I obviously don't have the volume for CNBC, but this happened to be when Trump was visiting the Fed. And it was hilarious to me. There was one point, and I couldn't hear it. I went back and watched the clips later and heard it later. But initially when they were talking, it looked kind of awkward, then kind of friendly at the end. Trump gave him a little butt tap there. It looked like he might have done that a little hard. Jerome might need a padded suit next time. But then the next scene, or a little bit later, I saw Trump standing in front of a construction area and there was no Powell. And I was like, boy, I hope he didn't throw him in a wheelbarrow and get him out of there. We got some more reaffirmation that it does not look like Trump's going to fire Powell. And I think that that's probably appreciated, although it seems like market kind of already knew that. Nonetheless, in an escalating feud between the two, President Trump visited the Federal Reserve and met Chairman Jerome Powell, having a public disagreement over the escalating price of the renovation work at the Federal Reserve headquarters. This occurred just a few days ahead of the Fed's decision on interest rates on July 30th. That's one of the things that we're going to be looking for next week. That's, of course, Wednesday of next week. Trump has been increasing pressure on Powell to decrease the interest rates while also backing away from his earlier talk of dismissing Powell before his term ends in May. Again, I don't expect that to happen. I expect Powell to be in his position until next May. And I think the market would probably appreciate that. That seems like the right thing to do. The 10-year bond yielded 4.42, so we're still under 4.5, but it did creep up a little bit. And the 2-year bond crept up to 3.93. I think this was 3.89 the last time we took a look at it. So those two moved up a little, but not too much. And it's nothing of concern, at least as of now. Analyst Adam Turnquist, the chief technical strategist at LPL Financial, he's actually been pretty good, highlighted that the advanced decline line reached new highs before the S&P 500, creating a bullish divergence that supported the case for a sustainable rally. Remember, Ryan Dietrich has kind of been saying the same thing with some of his stats. He's been looking at technicals. They look to be arriving at a similar conclusion here. This followed a recovery from the April 8th lows, showing broad participation, with most stocks rebounding sharply from oversold conditions. A rising advancing decline line is indicative of positive market breadth. Anne Marie tells us this all the time. This is one of her favorite indicators to look at. So it's great to hear that there are other financial analysts looking at the same thing. The advanced decline line is indicative of a positive market breadth as the number of advancing stocks is outpacing the number of declining stocks. The line is calculated by taking the difference between the number of advancing and declining stocks of an index for a given trading day and adding that difference to the prior day's value. However, Turnquist noted that, quote, over the past month, participation in the S&P 500's push to new highs narrowed. For example, without the help of a handful of Magnificent Seven names, the S&P 500 would only be up around 0.5% month to date, far below the index's 1.7% total return. Now, this is important because one of the things that I think we're all hoping for here is a little bit of broadening out amongst some of the sectors that are winning. That should actually make for better trading for us. In the meantime, though, we've seen this playbook before, right? We've seen the Magnificent Seven and the tech names really kind of carry the market for a substantial amount of time. So even if we remain in that environment, it's not as if we don't know how to play this already. We've been dealing with that already. So it really shouldn't be that much of a change up here. This has resulted in the advanced decline line falling and setting a new high earlier this month, creating a short-term divergence between price and breadth. And I think that's what folks are looking at. Quote, encouragingly, this gap is now closed this gap is now closed as participation recently expanded beyond large cap and or tech stocks. Yesterday's new high in the advanced decline line reinforces the health of the bull market, signaling a broader rally with receding concentration risks. Louis Navalier of Navalier and Associates. By the way, Louis has been just spot on. I know Tim Melvin and Louis know each other. Louis Navalier has been one of the best in terms of breaking all of this down, staying consistent, staying calm, and not knee-jerk reacting to some of the things that we have. So big time shout out to him. We shouldn't be surprised, but big time shout out to him. He explained that, quote, we are truly in a special environment and economic renaissance for the U.S., end quote. According to him, as Asia and much of Europe are in the midst of a demographic collapse, the U.S. is better positioned for household formation and better assimilates immigrants. Quote, furthermore, the U.S. is food and energy independent, plus it's benefiting from surging exports as well as onshoring. This is why the U.S. dollar suddenly got its mojo back, since it's obvious that the tariffs are going to help the U.S. to better manage the budget deficit. Who else have we heard say that? He concludes by noting that, quote, hopefully all the tariffs will be finalized on August 1st. The Fed signals that rate cuts will be forthcoming and virtually all economic uncertainty will end. As estimates for GDP growth steadily rise, I expect both business and consumer confidence will soar. Now, the important takeaway from here, at least in my opinion, is that he's saying here that hopefully all of the tariffs will be finalized on August 1st, and the Fed signals that rate cuts will be forthcoming. That to me means that we don't actually need to see a cut in July for the market to be like, okay, this is good. If we get any type of talk that indicates that a September cut is likely or probable, I think the market is going to respond positively to that. And I think it actually makes the decision in July far less important. We only have to wait a couple of days before we see if that's true, but that's kind of the camp that I'm sitting in right now. So we'll see if we end up getting that.